Volatility Index, the VIX, spiking to 58 yesterday afternoon after hitting its highest level since August in the wake of Fed Chair Powell's press conference. For his thoughts on how investors should be positioning in a more volatile market, I want to bring in Willem Sels, HSBC's Global Private Banking and Wealth Global CIO. And Willem, just to clarify, the VIX actually hitting 28 yesterday prior to seeing some of that volatility coming out of the market today here. You say that investors need to maintain an active strategy in a market with this much volatility. What does that look like?
Well, to a very large extent, this is obviously because we are going to go through a period where you have lots of policy announcements and therefore then people trying to assess what is going to be the impact on the economy, on inflation, and therefore on the Fed policy as well. So there are lots of things which we simply cannot predict. And therefore that leads to volatility, which you can see even already from yesterday. Volatility spikes don't tend to last very long. So, investors can take advantage of that by selling that volatility when it spikes. Other things that people can do is indeed, as you said, an active approach, because, if we cannot predict certain things, people can adjust their positioning when, for example, your yield curve steepens or flattens, when your interest rates go up or down, when your currencies move and so on, and tactically take advantage of that. So they can do that directly, or obviously through, fund managers that are very active, or even in the hedge fund space through long-short strategies.
Well, is there any fear from this, as you take a look at the spike in the VIX yesterday, that's longer term, or is it very much a short-term sort of risk that is being evaluated?
So when we're talking about equities, we need to think about what is also causing the volatility in the interest rate space. This is to a very large extent because we already have a quite strong U.S. economy, and at the same time, we potentially get further stimulus either through deregulation or through tax breaks. So in the equity market space, you have the positive side and the negative side together. That earnings growth, that we are seeing because of that resilient economy, plus everything that is to do with deregulation, with innovation, with government policies, that creates a very broad opportunity set. So I do think there are a lot of opportunities in the equity market, where companies are going to do much better than the very low earnings expectations that analysts have penciled in. So yes, to your question, those opportunities will materialize, and therefore, I rather see volatility as an opportunity.
You mentioned you anticipate more growth to come in the U.S. Given that you also anticipate more growth for the dollar, how much pressure does that put on the rest of the world? And does that set us up for a higher than not likelihood of a growth shock heading into 2025?
So the U.S. is the main engine of positive news in terms of economic growth, and that is in part what drives the U.S. dollar. It's those opportunities that are going to lead to investment inflows into U.S. markets, but it's also obviously the interest rate differential. If the Fed is slower at cutting rates, but the ECB continues to cut rates in the eurozone, then you have that attraction for the dollar. So indeed, we do expect a strong dollar. Eurozone equities have slightly benefited from that weaker euro, but I don't know about your clients, but quite often retail clients don't hedge their currency exposure. So we don't tend to see strength in the equity market that is led by currency weakness, as is the case in the eurozone, at a positive, because what they may gain on the index level, they may lose on the currency level. So we very much have that preference for the US. We try to diversify a little bit with UK stocks and Japanese stocks, as well as Indian stocks.
Willem Sels of HSBC, thanks so much for taking the time to join us.